The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. I'm Bobby Rains here for the Investors Observer Members Only Workshop. Let's go ahead and get started. So here is our agenda today. We're going to, as usual, go through a little bit of a market update, look at what's going on in the market, talk about what's going on at Investors Observer, and then the rest is member-driven content, questions, site demonstrations, anything that is on your mind that you're interested in hearing about from us. And remember, for this and workshops in the future, I'm happy to prepare slides ahead of time if you'll just send in a question and mark it workshop in some way. All right, so let us get into the market update. If you have questions at any point, just throw them in the question box, and we'll get to those either as they come in, or I'll save them till the end if they're not relevant to what I'm talking about at the moment. All right, so market update. Briefly, it is not so hot. I missed the last 10 minutes or so of trading today because I was coming out here for this, but it didn't look good when I walked away from my desk. Yeah, this is the last year of the S&P 500. We've broken below pretty much everything. There's some support down below this 2,700 level, although this 2,700 level was cited by any number of people as a pretty key level of support, as was the 2,800 before it. 2,800 we kind of bumped up against after we sold off in January, February. It took us a long time to get back above there. So we'll talk about recoveries a little bit later, but yeah, at some point the falling has to stop before the recovering can start. So there should be some support somewhere down here in the 2660 sort of range, and then there's some others below that. Probably if you look on a longer term chart, which I think is my next one. Yeah, there's further support further down here, but I really pulled this chart out to show that we've also broken below sort of a three-year trend that goes all the way back to early 2016. Yeah, goes all the way back to here, and then yeah, we sort of broke pretty solidly below that, unfortunately. So that's not particularly exciting by any means. Yeah, so we'll see what happens. Is the long and short of it. You'd like to see some support levels hold at some point, but so far it hasn't really been particularly encouraging. And then yeah, here's the Dow. We have pretty much a similar thing. We're below the 200-day moving average, which isn't usually a good sign. And again, cracked back below. Took out several round numbers, 26, 25. Maybe we'll hold at 24. And those next support levels, there's some less strong ones there in between where I put them there, a little above 24 and at 23, call that 2350. So those are the next sort of big strong ones, but there are some other less important ones in there. The NASDAQ is a pretty similar picture. The action in the NASDAQ on a percentage basis has been uglier. The NASDAQ was, had maybe flown a little bit closer to the sun than the others. But you can see it kind of made a little bit of a double top up here. It really got well past the January highs, whereas like the Dow pretty much topped out at the high it hit in January. And the S&P got a little above it, but not nearly as dramatically as the NASDAQ did. And then, yeah, this was a sort of a support level we were really hoping we would see hold. We had this, some people call this an island top or something, back earlier in the spring. But yeah, we sort of tested it and came back and then went right back down through it again. So 7,100 looks like another good level to look for, but yeah, we'll see what happens there. But I did want to talk about sort of this looking and feeling very different from recent market disruptions, in the sense that, so this is a chart I took from Bloomberg today. When we had the number of down days, usually we have some sharp down days and then some pretty sharp up days. So like after the won devaluation back in August of 2015, in the month following the sell-off, or the month including the sell-off, the number of down days and the number of up days were pretty close. December of that year, pretty similar thing. And then the big sell-off earlier this year that Bloomberg is calling the volatility blow up here, it was pretty much the same number of down days as up days. And yeah, the last month plus 2 days here has not had the same level of parity, which is interesting in the sense that it feels very different this time. And just from watching the market, it feels very different in the sense that we're not seeing, a super sharp sell-off and then a leveling off during the day. We're actually seeing a number of false starts where overnight news will come in and the market will open higher and then just trade lower throughout the day. And so we get, I don't have a daily chart in front of me, but we get these sort of things where the stock just kind of, or the market just kind of marches downward throughout the day, which seems pretty orderly, which I guess is nice for market function, but is less encouraging from a sort of psychology standpoint, as what you really look for in terms of finding a bottom is a moment of panic, right? Like sort of that sheer terror where the market's taking out percentage points in a matter of minutes, as opposed to just I don't want to call it leisurely because it's been pretty severe, but a pretty orderly march lower, which is what we've seen, which is a little bit strange. And then here's another chart I put together with some, so this is actually from 2014 to early 2015, but you can see what I'm talking about here in terms of a couple down days and leveled off and then right back up to new highs. And then this was a little bit longer, but again, I mean, the upside was just as steep as the downside. And then these are a little bit smaller, but from here to here is only a month or so, maybe. Yeah, that's the end of February, and that's the start of. Yeah, I mean, that's back to new highs in a month, whereas we've been just going lower and lower and lower for a month now. So, it certainly feels different this time, which is all I really can say about it. I mean, there's also a lot of things going on. So if you think about this chart, right, like, won devaluation, global growth concerns, inverse volatility products blew up. There's not one thing going on this time either, which maybe explains the difference. We'll talk a little bit about that. Here. All right. So earnings is the big news right now. The reactions have not been great. Netflix beat and put up a huge opening gap and gave it all back in like less than 3 days, which isn't particularly encouraging. And I mean, I put beat in scare quotes there because their subscriber numbers beat, but Netflix is still essentially burning cash. Right, I think they announced earlier this week they're going to borrow another $2 billion. So, yeah, I mean, at some point Netflix can't just keep burning cash and the stock going up. So that maybe it makes sense. Caterpillar, on the other hand, though, is not, it's not Netflix by any means. Has a profitable business. They turned in a record quarter. Their guidance was soft, but essentially what they said was they were going to earn, they're going to be earning, earnings are going to increase at a slightly slower rate, which is sort of right, it's not earnings are going down, it's just the rate of increase is slower than people expected, which is, I don't know, I tend to not like it when people start trading the second derivative. It's a sign of things being a little too frothy. And they also warned about price hikes, which isn't good. And then I didn't listen to the call, but if the economy is slowing down in China, Caterpillar is the world's largest provider of construction and mining equipment. So at some point, a slowdown in construction anywhere in the world probably ends up back at Caterpillar on some level. And yeah, in trade, I mean, Caterpillar mentioned the tariffs as well, right? If you're making big things out of steel and the price of steel goes up, your probably business is going to be affected by that. And yeah, the Blue Book came out today, and mentions of tariffs were higher than pretty much any of the previous ones. And the Blue Book is interesting, or sorry, not Blue Book, Beige Book. I put the wrong color in there. But yeah, so the Beige Book is essentially the 12 Federal Reserve banks compile a collection of sort of anecdotes. They basically just call people and say, "Hey, how's business?" And so it's always a sort of interesting thing to read. It's not a narrative at all. It's just it's a collection of anecdotes. So you get, oh, in Dallas, people reported this, and some people said this, and oh, the trucking companies are having a hard time finding truck drivers. So you get some stuff like that maybe or may not show up in the just the numbers economic data. So it's always interesting, but it's, again, a collection of anecdotes is not actually data, so it's a little bit hard to know exactly what to make of it, but it is interesting. And yeah, the housing data has been pretty consistently bad. Pulte reported yesterday, and their report was good, but it was good compared to expectations, which were incredibly low. And then more bad data came out today, so if I had had more time to prepare, I probably would have pulled a chart of some of the housing ETFs, which are just miserable. I did put one in the blog post we posted Monday afternoon. You can go look at it there. They're down. I forget what the number is. Down huge this year, which is not particularly encouraging. Home building is usually a sign of all sorts of things in terms of economic growth, and so when those guys struggle, it can be a concern. And then, yeah, politics all around the world are kind of shaky. There's still no real plan for Brexit, which is can potentially affect all of Europe, and also like England by itself is a pretty big economy. Europe also has an issue with the budget in Italy. And then, yeah, the whole situation in Saudi Arabia, which is certainly a concern for all of the energy things, as Saudi Arabia also is. But Saudi Arabia is also, it turns out, a huge tech investor in terms of things like startups. So SoftBank is a big Japanese-run sort of investment vehicle. I don't know there isn't really a good analog to it here in the US, but they collect a tremendous amount of money and then invest it. And some of their largest funds are primarily made up of Saudi Arabian money. So, if Saudi Arabia pulls out there or gets sanctioned somehow and can't invest overseas, that's a source of money that ends up drying up, which affects everybody. So yeah, that's what's going on. I mean, some of the stuff, right? Like Boeing had a good earnings report today. McDonald's had a great report. Procter and Gamble had a great report. So it's not all bad, but the market reaction has been good for some stuff. It was encouraging today to see Verizon go up after beating earlier this week, even as AT&T went in the other direction. I was a little bit worried after AT&T missed that Verizon could lose that ground. So it's not all bad, but you definitely have to look a lot harder to find things that are going up than you did the last time we had one of these, or certainly 6 weeks ago, which would have been 2 workshops ago. But yeah, so that's where we are, and I didn't actually get any questions ahead of time. So with that, I think we can open things up to questions. Oh, I do. What's going on in Investors Observer is we're testing a portfolio tracking software. If you're interested in that, you can hit the help button on the website and say you want to be a part of our test program, and we can get you involved there. If you're already in the test program, thank you. Please let us know if you see anything. I mean, even things to the level of I didn't know where this button was, or things like that. Like we're trying to put a thing together here, and so like language changes, if what it says on the button is confusing, all of that stuff is the kind of data we're trying to gather. So there's no quibble that is too small. Even if you couldn't figure something out and then did figure it out, let us know, because that probably means it's too hard to figure out, and we should try to find a way to fix that. So to all of you who are involved, thank you. Keep up the good work, and yeah, let us know what you find, what we can do better, any of those things. So with that, let's go to questions from the audience. All right, so we have a question about puts, which trade idea generator. Yeah, so you can find short puts here. A put is, let me pull this back down just for reference. We had lots of meetings around here about these two icons, because these icons are all basically, well, the diagonal spreads are a little bit different. But the idea was to put essentially the P&L charts for each of these strategies. And so a short put is functionally the same strategy as a covered call. You sell a put, and if the stock goes up, the put expires worthless. You keep the credit you got coming in, which is, all things considered, pretty similar to if you had done a covered call at roughly the same strike price. In a covered call, you buy a stock and then sell the put or sell a call against it, which means that if the stock goes up, you end up selling the stock. You keep the difference between what you paid to get in and where you got out. Whereas in a put, you're essentially selling a put, and if the stock goes down, you have to buy the stock at the strike price of that put, and so your cost basis ends up being the strike price less your credit. So they're pretty similar in terms of what the P&L is. And yeah, in a market like this, yeah, lots of people end up owning stock that they sold puts on, is typically what ends up happening. And I mean, you can buy them back, but what you end up doing is you end up paying an awful lot to buy them back. So ideally, when you're selling puts, and this market is tough, because yeah, things just keep going down, and so your puts get to be in the money pretty fast, and then you got to pay a lot to get rid of them. And so if you're selling puts on stocks that you don't mind holding for a long time, I mean, you bought it at a discount to where it was when you put the trade on anyway. Another thing you could do is try to buy a put at some point, which would turn it into, if you can get it, turn it into a credit spread. So you only lose the difference in the strike prices at that point, less whatever the net cost of the two options is. You can also try to roll the puts, but again, it gets, you're probably better off just taking possession of the stock and then turning it into a covered call in that case. Just because rolling the puts, you end up chasing the market down potentially. Whereas it's a little bit easier on the call side. The liquidity is usually a little bit higher, so there's usually a little bit less bid-ask spread to have to fight against when you're trying to roll things. But yeah, I mean, managing a cash secured put is a lot like having a covered call, where you sometimes are just underwater on a stock. And yeah, especially in this market, I mean, you can buy them back if you don't want to own the stock, but you end up paying pretty much the difference between whatever the strike price is and the stock's current price, and then any time premium, if that remains also. So it can be, on some things, where the market, some stocks have lost 10 or 20% of their price. That can be a pretty big nut to have to come up with to pay. But if you don't have the cash to buy the stock, then maybe that's the way to do it. All right, other questions? Yeah, so those of you who are portfolio subscribers who have probably noticed we're a little light in terms of putting out new positions. That's essentially because we don't, I mean, certainly in the covered calls portfolio, we don't just want to keep putting out long positions when the market is falling, especially bumping up against earnings. I mean, there's some stuff that just reported that we're looking at. We may put some stuff out in terms of those names later this week, but we really don't want to be super time constrained getting into a falling market. And then on the the diagonal spreads and the vertical spreads where we can go sort of bullish or bearish. The last thing we want to do is take losses on a couple of long positions and then put out a bunch of bearish positions and have the market snap back and get burned on both sides. So we're just kind of trying to wait until we can find find something we feel comfortable with, or until there's some clear direction to the market. Typically, downturns have been relatively short. So we're not, I mean, we have a position on a Chinese stock that's closing Friday of this week. We have an order out for it already. So, we put that one out, and we're looking to do some short-term things here and there where we can, but it's, we really don't want to, we're sort of in capital preservation mode at this point in terms of not wanting to put out longs that then get swallowed by if the market keeps falling, and not wanting to, put out bearish positions and then have some kind of snapback rally. So that's where we are on that. We're here every day trying to find something that we think will work, and we just haven't really found anything we're super confident in. But as earnings roll in, and hopefully the sheep will start to separate themselves from the goats a little bit, and we'll be able to find some things that will work. Yeah, Jeff, Jeff has a note in here about Tesla, thinking it could be ripe for a short. It's certainly possible. I just got a note that they were profitable. Just got an alert on my phone that they were profitable for the quarter, so that's probably why they're up. I haven't read the report enough to know if that means GAAP profitable or some sort of Tesla accounting metric profitable. But yeah, Tesla has been sort of on my stay away list for a long time because it trades pretty wildly, and both the bulls and the bears seem to be pretty convinced of their situations, or pretty convinced of their positions, perhaps at a level that is a little past just what the numbers say. And we generally try to stay away from things around here where people are trading the stock in either direction on emotion, just because they're too unpredictable. But yeah, that is, I mean, given how Netflix faded after earnings, Tesla may not be a bad play there. I don't know. It will be certainly interesting to see what happens tomorrow. All right, well, if there are no more questions, I'm going to go ahead and sign off here. If you have more questions, put them in the box. I'll give it another couple minutes. But yeah, we'll put a recording and a link to download these slides up on the website and send an email to everybody tomorrow. Obviously, you can hit this help button if you have a question or concerned about something. That'll send us an email, and we get back to those pretty quick. If you're interested in trying out our new portfolio tracking system, just hit the help button and tell us you want to try that out, and we'll get you get you involved in that program as well. All right, well, I'm going to go ahead and sign off here. Thank you all for coming, and I will talk to you again in 3 weeks. But if you have a question between now and then, let me know, and we'll be happy to answer it. Thank you.